Hey, it's Chris Burns with another edition of Coffee Chat. And once again, I'm having Alex, our lead advisor in the Destin, Panama City area, join me today. How you doing today, man?
I'm great, Chris. How is Louisiana treating you?
Just as cold as where you're at the moment. But Alex sent me over a topic, and I figured it would make a great addition to Coffee Chat. And one of the things that Alex brought up, and which we're going to talk about for the next few minutes, is common holes or deficiencies that we see in either putting together a retirement plan or helping someone who's already retired. What's one of the big things that you see pop up from time to time, Alex? That's something you would think is common, but you see it more often than not.
Yeah, around, especially this time, day and age right now, since interest rates have been so low, we often see the question of, should I pay off my mortgage? Right, that's my last debt that I have before I retire. You know, I'm paying X amount of dollars a month. It's my biggest expense. Should I pay that off so I can basically scratch it off my list? So no more debts, right? And paying off your mortgage, don't get me wrong, is a big deal. But a lot of times it doesn't make sense. And it's not going to be a blanket answer for everybody. But what we see often is folks just have the assumption that they can go and take X amount of dollars out of their retirement accounts, right? They're past the age of 59 and a half. They know you have to wait that long. That's commonly known. But what they don't realize is, say, for example, you have to take $300,000 out to buy that home that you're looking at. Well, you're going to have to pay taxes on that, right? Every dollar that we draw out of that is going to be counted toward an income tax. Now, say this couple makes $100,000 a year. They take out $300,000 from an IRA. Now their income is at $400,000 a year, and their tax liability is going to be big. And if they don't know that, they may take that $300,000 and purchase that house, and they get it with a huge $80,000 tax bill at the end of the year.
So, and then pay taxes on the purchase of the home itself.
Right. So,
and then it kind of just keeps going down that rabbit hole. I mean, then it could have an effect the way that their Social Security is taxed, the way that if they're currently of Medicare age, what they're going to pay on a monthly premium there. So yeah, it is a big thing that we see from time to time, and there's a right place and a wrong place to take assets from to make a large purchase like that. And retirement assets, we normally like to steer clients away from it. It have to be a pretty unique circumstance. I mean, I can't say never, right? But it would be a very unique circumstance where it would make sense. And one of the things that you said just a moment ago that I want to add to is you mentioned inflation, not taking into account inflation. Well, we just saw the numbers come out for January, and I think it came out at 7.5. That is incredibly high. And so a lot of people are getting closer to retirement. So we'll come across individuals who have like a large amount of money, like in cash or sitting on the sidelines and things like that. And they're like, well, at least I'm not losing anything. What's your response to that?
Well, I think you can see my facial expression there is, essentially your money is safe and you're not losing money. But what people don't think about often is inflation. And basically what inflation is, it reduces that purchasing power of those dollars today. So if inflation long-term, say is 7%, say we had 7% inflation for 10 years, highly unlikely, but if we did, your expenses would theoretically double. So the expenses that you meet today, day one in retirement, say it's $50,000, that turns to $100,000 10 years from now if you run inflation at that high rate. Historically, inflation is supposed to be between 2 to 3%, but that's not what we're seeing recently here because of the COVID pandemic and supply chain issues and the never-ending talk about that. So, one thing that we need to focus on and what we see often is folks will come in with their expenses. Okay, well, I don't have a mortgage. It's basically my living expenses. Well, we need to take into account, retirement's a marathon. So you don't just need to focus on today, tomorrow, the next day, but you need to think 25, 30 years down the road and how inflation can impact what your expenses are at that point.
Well, like you said, I mean, people are living longer, and most people, statistically speaking, one spouse should see age 90. So we could potentially see 25 plus years of retirement. And so it's like you said, it's a marathon, not a sprint.
Right.
And so we talked about inflation, but we just said that potentially retirement could be 25 years. Another thing that people don't take into account that kind of brings those two together is what taxes will look like inside retirement. People think, oh, well, I'm retiring, my taxes are automatically going to go down. Not necessarily, right?
No. We see a lot of the time, you hear the savings method growing up and throughout your whole life is, look, defer those taxes, save, because you're gonna be in a lower tax bracket when you're older. But when you take into account, right, that can happen, but a lot of times we're seeing it doesn't, because what if this individual has a social security, a pension, rental income, and then now they have this big tax time bomb, an IRA or 401k that they now start taking money out of. Eventually, at 72, the government makes you. And then at that point, you're not really in control of what taxes you owe at that point, because you're required to distribute X amount of dollars out of those accounts, which can then bump you up into a tax bracket that may even be higher than when you were working. So focusing on that and controlling that, we want to tell that tax story as often and as controlled as we can, versus the other way around. Because
and to add to that, taxes, once you get over that age of 72 and you're required to take those distributions,
right?
And to compound that one step further, death of the first spouse. After you've been filing jointly for your entire time being together, and that's going to come to an end a year or two post death. And now you're going to still have to take those requirement distributions. Right. Instead of taking it at that joint tax bracket, you're now down in the single tax bracket. And if you don't account for that, you can really shoot yourself in the foot, because you work with us, so you know how we break it up into 3 different tranches, right? The first 10 years of retirement, the middle, and the back end, right? Well, if the plan falls apart in the back end, it could be almost impossible for you to go back out into the workforce then. So having all that time frame to plan for the what ifs and the worst case scenarios, that's kind of where that financial advisor really does kind of come in and can help with that retirement plan.
Yeah, we don't want to run into a problem in retirement 10, 15 years down the road, right? We talk about some people go back to work maybe a year or two because they get bored. They find that maybe retirement's not for them. They enjoyed what they did for a living, and they get back to some sort of work, but that's voluntary. We don't want to have the involuntary work where you have to go and you have no choice. Otherwise, your expenses are more than your income is, and you have to work. So that longevity, making sure that we're taking care of you in advance before we get there, is a huge factor when it comes to retirement planning.
So I kind of think the really big thing to take away from this chat that we just had is have a plan, right? But also stress test that plan, because if inflation's at 7 and we anticipate it falling back down to the 3 to 4% range, well, what if you kept that plan and ran those scenarios at 7% and they were successful? That's good, right? Just like you also need to plan, okay, if my taxes go up because of a death of a spouse, or I go up an income bracket, these are all things that from a planning standpoint, let's stress test all these items and understand that when A happens, we're going to do B. So before we finish up, I know that you brought this topic to us today to talk about. Is there anything that you want to close on?
Just make sure that it's easy to push these things off. I actually met with somebody yesterday that said, we've been meaning to do this for 6 or 7 years now, and it's life gets in the way, as it does, but pushing these things off can impact your retirement more than you think, because the longer we can have this plan in place, the more time we have for it to work, and time is your friend. And if we have more of it, then the better we can do for your retirement.
I agree, man. Thank you for bringing this topic to Coffee Chat, and look forward to seeing you in person next time.
Absolutely. Thanks, Chris.
All right, man. You have a good day.
You too.